Japan's main stock indexes hit record closing highs. Welcome to Market Insight, I'm Ramzan Karamali. Shares of automakers, banks and technology firms led the way as markets expect a robust corporate outlook in the latter half of the year. The battered yen also seemed to get some support today too, though it still remains pinned near a 38-year low. The market seemed to be on alert for government intervention when it comes to the currency, but what exactly will policymakers do to shore it up? Well, to help answer that and more, I'm joined by Robert Carnell, Head of Research and Chief Economist at ING Asia Pacific. Robert, thanks so much for joining us. So both the topics and the Nikkei hit record highs today. What do you make of that?
You talked earlier about the second half of the year. Looks like we're going to get some slightly better, more robust economic data out of Japan. And we'd agree with that. But I think if you were to adjust what's happening to either the Nikkei or the topics for the yen's weakness, what you find then is that in say, US dollar terms, it's actually risen by about 7%, which is broadly in line with European bourses like the DAX or the FTSE. So it's nothing that special. And the yen is doing a lot of the heavy lifting here.
Well, we'll talk about the yen now. Officials have intervened in the past when it comes to the yen buying the currency. Should we expect more of the same, or what else can they do?
What we've seen in the past when they've intervened is it hasn't been terribly effective. We know that when they come in, they might have an impact for a day or two, or maybe just a few hours. But the stark, staring fact that there is a whopping great big gap between Japanese policy rates and those of the United States mean that until we start to see some proper changes in the policy stance from the Bank of Japan, that pressure on the yen to depreciate is just going to stay.
Well, we haven't got too long to wait for the Bank of Japan's next meeting. What are you expecting to hear there?
Well, we do actually think they will hike rates by 15 basis points, 0.15 of a percentage point. And that would take them to 25, quarter of a percentage point. Compare that to the Fed's 5.5%. It's still a big, big gap. And we think we're going to get further tightening through the back end of the year, another 25 basis points then, taking the end of year rate to 0.5%. But unless we start to see the Fed cutting rates, it's still a way off international norms for interest rates.
So I guess a lot of this depends on what the Fed do next as well.
Yeah, absolutely. I mean, it should be all eyes on the Fed rather than all eyes on the BOJ. Obviously everybody is watching all the numbers coming out, whether it's labor market data or the inflation numbers in the US, to see whether or not we're going to get the easing in September, as a lot of people are thinking, and whether we'll get further cuts through the back end of the year. That's what's going to drive dollar weakness, we think, and that's what's going to underpin some of the other movements in the region.
Now, today we get EU tariffs on China-built EVs kick in. China seems to be in the middle of some major trade tensions, to put it lightly, not just with Europe, but with the US as well. How damaging is this for the world's second largest economy?
Yeah, well, the backdrop for China isn't a good one to start with, so it's not helpful. And tariffs generally, I don't think any economist would argue that they're positive for growth globally. They're a kind of beggar thy neighbor game. You steal a little bit of their growth to make yours look a bit better. The European tariffs, they're somewhat more nuanced than the US tariffs that were implemented recently, where 100% tariffs on EVs were put in place. Europe's were a little bit more restrained, and there's talks apparently going on to try and come up with some solutions. So it isn't quite the abrupt policy that the US put in place, but it doesn't help, certainly, when China's biggest growth engines are exactly these areas. It's e-vehicles, it's artificial intelligence, it's the energy transition. All of these things are really seeing tariffs put on them. And of course, what it also does is slow the process of adjustment for regions like the EU, which are trying to decarbonize.
Now, on Friday, we get the latest inflation data out of the Philippines. What are you expecting there, and how soon could the central bank there begin cutting rates?
Well, the Philippines is a very interesting one. I think their inflation numbers that will come out on Friday will not be markedly different to the numbers that we got last month, somewhere around 4%. I think the consensus is looking for 3.9, could be a little higher than that. What's interesting is they're going to be cutting the tariffs on rice. In fact, they've already started doing that. That'll come in at the back end of this week. And that is contributing 50% of all the inflation we're getting in the Philippines. So that suddenly, from next month, drops. We'll see inflation dropping to, maybe even something a little below 1%. The central bank's already talked about the possibility of cutting rates in August. And I think with inflation down at those levels, it might find room to do so.
Robert Carnell from ING Asia Pacific, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.